So hello and welcome to the last panel of the day. It's going to be a tough act to follow, and hopefully we can keep you interested until the end because I know there's some beverages to come. So as Ian mentioned, my name is Marissa MacDonald, and I know that he gave a wonderful overview of all our panelists, so we can actually probably just jump right into the conversation. So today we're going to be talking about custody of digital assets. We're going to talk about how custody is regulated and supervised. We'll talk about security and risk considerations, and then we'll also talk about the importance of making a thoughtful choice on type of custody. So to start us off, just kind of starting with the basics, Daren, to lay the groundwork, what are the different ways that an asset owner can custody their digital assets, and why is that choice of how one custodies so important?
Great question. Yeah, so I guess I would start by saying that there is a choice of custody when you talk about digital assets, right? In traditional finance, up until 2012, there was no choice. If you had money, assets, securities, et cetera, they would be held by a QC, qualified custodian, and that was the one and only way that you could operate in terms of storing your wealth. Now, with digital assets, there's a choice. You can select whether to place your crypto with a custodian. If you leave your coins on an exchange, I guess you're sort of doing that. They're not a qualified custodian, as we're finding, but that's one thing you can do. And you can also choose to have your own self-custody wallet, where you can store your assets and handle them yourself, or you can even have a hybrid environment where you can work with a multi-signature wallet environment and have someone else help you. That's called collaborative custody. So there's this array of new choices with custody, and none of them are wrong or right. There's just different applications for all of them.
So just pausing for a second on the idea of self-custody, what are some benefits or risks to self-custody?
So maybe I'll jump in there. One of the things that we kind of look at closely is when you talk about custody, I think oftentimes people kind of confuse when we talk about ownership, right? So we had kind of an interesting disclosure with Coinbase, for example, back in August this year, that was May, about what actually custody means and what would happen, for example, in the event of an insolvency. And I think one of the things that we look at, if you think of it logically, custody, you know, whether you're looking at self-hosted or on an exchange, I think looking at it through the lens of actually what that means in terms of your entitlements as maybe legal ownership, for example, is actually risk number one, and what may occur in terms of ownership. I think the other things that we look at is things like security concerns. I mean, I think there's a reason why people choose to self-custody their assets and keep it off-chain. We're also seeing kind of things like, I suppose, the natural evolution of the ecosystem, where originally exchanges were maybe the hotspot for like breaches and things like that, and then you're seeing now like recent exchanges, you know, things like bridges being exposed with either smart contracts. So I think I look at it through the lens of really people understanding the choices that they're making, right? I think the other thing that we look at is, which happened early on, was there was a lot of exchanges that perhaps were launched by questionable actors themselves, right? So you had things like rug pulls. And it's interesting, so a lot of us have no problem opening an account with JP Morgan or whatever because we know they're a regulated entity, but oftentimes we kind of have no problem putting $1,000, let's say, in an exchange or a DeFi that we literally know nothing about. And oftentimes you kind of question what that needs to be. So there's a healthy level of kind of self-responsibility I think people need to do and look at where they put their money and what they need to do, and then understand the choices and the risks that they bring, right?
Great. So Paul, you just mentioned, you were talking about traditional finance. Daren, I think you had used the term, you were talking about centralized exchanges. So just kind of laying down, just definitions-wise, Tom, could you just walk us through some of the differences between traditional finance, centralized exchanges, and then decentralized finance?
Sure. So just as a way of background, I came at this from traditional finance. I spent 15 plus years in the currency trading world, very much in the traditional finance space. And in traditional finance, you know, the great thing is you have security. If you're a consumer, you go open a bank account. If that bank goes under, you still have insurance up to $250,000 under the FDIC. If you put your money with Fidelity, you've also got the SIPC that insures your money. So you get lots of security. Sometimes you don't get convenience in traditional finance. If the bank is closed on a weekend, you can't go in there. I think in the world of internet banking, it's different. But traditionally, this space was very much of a regulated, secure space. You know, my first time to play around in Bitcoin, you realize very quickly if you lose your password, you lose your coin. So you're thinking, well, hang on a second. But I think as you've seen DeFi and CeFi evolve, there's a few things here. One is code is law. So you agree to you know, your coins have a password. You've got to hold on to those passwords. You know, I think what we saw this past year as crypto came down a little bit, most of the collateralized lending done through DeFi, it seemed to be an orderly sell-off. Even though you had a lot of stop-loss selling, it worked okay. If you were lending in those spaces, you got your money back. CeFi was interesting this year. If you look at groups like Celsius, that were doing a lot of lending in a way that was sort of off balance sheet or not in a regulated way, when push came to shove, some of those assets really could be sold in time, and you created a lot of losses, and unfortunately there were some companies that went down. So I think you're seeing some awareness that CeFi does have some gaps, but I think what we're seeing increasingly is that you've got to be buyer beware. You've got to understand what you're doing. In some cases, some of the DeFi groups, what we saw with Luna, and having a situation where the setup just was not well thought out, or the code wasn't right, and you've had some big hiccups there as well. But you know, from my perspective, you know, seeing what's happening in traditional, the transition from traditional finance to the DeFi and CeFi space, I think we're getting better, we're getting smarter. And I'll say one more comment. In my previous startup, we were investors in marketplace lending. So we were buying loans issued by the likes of Lending Club. And as we grew our fund, our investors said, well, you need to have a custodian. So we said, sure, we'll get a custodian. And so our custodian said, we'll hold the electronic copies of your loans. Oh, well, hang on a second. What exactly does that mean? But the reality was, I don't think that the digital world has caught up to many areas of traditional finance. And I think when we get there, blockchain will give you that proof of concept, will give you that proof of ownership. And I think that a lot of these transitions are still working their way through the system.
Great. So assuming you have decided to custody with a custodian versus a self-custody situation, what are some of the chief considerations when making that choice of custodian? What are some of the things you think of? And this is for you, Tom, this is also for Paul and Daren to weigh in as well.
Sure. I mean, I think that depending what asset you have, but the custodian, in traditional terms, highly regulated. They held your assets safekeep. They abided by the rules. They sent you a quarterly statement separate from your fund manager. And you know, as you look to transition to the digital world, I think we want convenience. We want simplicity. We want security. But what we want is a more modern way of doing this, I think. But
yeah. Daren?
Yeah, I mean, there's different applications for each. I mean, if you, back when Celsius existed, it was very compelling to suddenly have a new interest rate earning option, right? There was an innovative company that would pay you interest on stable coins and other cryptos. And so by definition, you had to put those assets in custody. And you, the customer or the consumer, were weighing the risks of, okay, I'm going to post my money here, but get a yield. I'm going to weigh that risk. And of course, I lost on that risk, and anybody else did too. But there are other sort of times when you don't need custody. Like, for example, if you just have a long-term holding position, I mean, that's just, there's no need for custody. And I think that's what, you know, this harkens back to the prior couple of panels that were discussing, like, you know, 1940 and 1933, you know, SEC regs. And there was a need then with people just walking around waving $100 bills saying, where do I put this? I don't have a place to put this. Well, we don't have that problem anymore. I have some of my Bitcoins and I have them in my wallet, so I don't have that acute need for somebody to put them into their custody. So that would not be a case when you would need that service. And then something in the middle might be, you know, if you were another service that's emerging in our industry is just lending. So if you want to post some crypto as collateral and receive a USD loan, of course, that is another custodian situation. And again, you have to weigh the risks of if that business is going to be around when you go to claim your collateral. There's just not enough. There's not enough confidence of which players are putting assets on their own balance sheet, as Tom mentioned, versus segregating them, putting them in cold storage or on-chain wallets. It's just very murky. Like as a consumer, you just don't know what you're getting when you ship your Bitcoin up to XYZ, exchange or a service. There's not a cognizance of the risks involved, and I think we need to work on that.
Yeah, and I think just to add to that, I mean, if you think about what was the purpose for exchanges in the first place, I think it was the ease of use for people to be able to, wouldn't necessarily be familiar with self-hosted wallets, to be able to interact and purchase these assets in a simple and more intuitive way. I think as the ecosystem evolves, right, so exchanges serve the purpose, but I think there's still some way to go to kind of building out the infrastructure that we're kind of used to in the traditional financial ecosystem. I mean, Tom mentioned there earlier, and there's actually, if you think of it logically, there's some very simple solutions to this, right? So we have blockchain. The assets are on the blockchain. They can be publicly verified. In a lot of cases, they're public. So why isn't that information actually, in a lot of cases, accessible and known to the public, right? Why, when you rely on independent custodians to publish quarterly financials, this is the stuff that actually should be readily at hand and available to everyone. So there's some really interesting ecosystem, or I call it infrastructural pieces that can be plugged in, I think, quite simply to actually solve. And I think what you're seeing now, especially from the industry, and I think proven from folks up here, you're starting to see, no disrespect, but I think the adoption of blockchain from beyond the people that really have, let's say the strong engineering or computer science background and see this as a cool thing, into the real-time industry where people are seeing some very real problems. We understand, we're in this like market reset at the moment, but I think everyone that really understands the next wave of growth, which requires to track the institutional money and all these other things, is going to require these kind of plugs to be filled, right? So, and that's what you're going to start seeing happening.
Great. So I know 2 panels before, there was a conversation related to the regulatory environment and getting those compliance policies and procedures in place, which is one of my favorite topics to talk about. But just kind of thinking through custodians and in this space, who are the regulators that are watching over providing this supervision? How is this area regulated?
Somebody said it earlier, patchwork quilt of just bizarre state, federal stuff. Yeah. And, I think literally anybody can just raise their hand, get a state money transmitter license, and technically you can custody crypto. I believe it's that easy. So it's probably not a rigorous enough standard at this point.
It does require you to have a BSA AML program. So,
yeah. Keeps us in the job, right?
Yeah, and so, then you run into stuff like Celsius occurred, right? And sure, they were registered with NYDFS, and, they had a, bit license and everything, so New York was looking at them, but they weren't looking at them through the lens of you're a custodian, do you have proper amounts of collateral, do you have a third-party auditor, and is that report constantly available every 30 days? Do you post your collateral findings? These things just weren't in place, and so more to Marissa's question, there currently is no, I don't believe, like specific track for regs related to crypto custodians. It's very amorphous right now, I think.
Yeah.
Yeah, I think it's we were talking about it earlier. One of the things, just decision, like you think about the regulatory landscape, and I think the implications it has as an entrepreneur. When you're looking at this space, you're almost making decisions based on how you can get the path of least resistance, right? And I think that's the part, unfortunately, that stifles innovation. When you see what's happened in other industries, like let's say the cannabis industry and everything, I mean, this requires federal direction. And I suppose, even though I think we got still some way to go, you're definitely seeing kind of more velocity and movement in terms of action coming out of DC. You see the Biden executive order. You had the Gillibrand-Loomis bipartisan bill that was sponsored, which I'm not sure if anyone had read it, but I think for the first time I had actually seen a kind of a clear framework that defined very clear definition of terms in terms of how they define digital assets and virtual assets, right down to actually how they believe different players in the space, be it custodians or brokers, should actually register. And while they kind of favoured the kind of the approach with the CFTC, that I think turf war has some legs yet now. It's going to play out, but I think it's a start. It's the start we need. But I suppose the other thing that I would say, just my experience working in financial services, there is a real opportunity. I think there's a reason why things work in the traditional space, and one of the things we're seeing right people now moving from trad space into the spaces. There's things that have been proven that work in the industry in these areas, and it's a matter of just now transforming them over and adapting them into the space. I mean, fundamentally, blockchain is an enabler of an exchange of value, right? So there's no reason I talk about the infrastructural elements, but the application of tried and trusted methods will start getting into this space, and really, there's no reason to reinvent the wheel,
So you talked about the turf war. I think you're referring to CFTC. We see it from SEC. We see the state regulators kind of taking their chunk. So just thinking about maybe something more positive in this space versus kind of this evolving landscape of regulation. But so Biden issued his executive order back in March of this year. It was focused on the digital asset space, from everything from illicit finance to innovation to safeguarding consumers. We finally have gotten to the point where all of those many officials and agencies have handed in their reports. We're starting to see the report out. So Tom, based on the discussion we've been having around custody and digital assets in general, is this a positive thing? Do you see us, where do you think we're heading from here?
That's a good question. So I think that the evolution of regulation is, we are early in that process. We tend to find regulators stand up very quickly when there's been a big issue, a big loss, a big blow up. But it's, the U.S. is unique in our sort of regulatory process. I spent much of my career in the UK. The UK has a single financial regulator, the FCA. Anything from retail to institutional to fixed income to equity, it's all under the same umbrella here. I spent the last 8 years as a fintech entrepreneur. It's hard. It's not an easy process. So I think ultimately, what we always ask ourselves first, who are you selling to? Who is your client? Is there a retail component that needs protection? And start from there. But it is complicated and it is challenging. But I think that, when you look at the executive order, it was a lot of very high-level objectives. It didn't really give any kind of granularity on where we're going. And I think to some extent, there's a lot of lobbyists that are busy at work trying to make sure these rules are crafted in such a way which gives us the ability to move forward in a way that we know that we're confident that we're abiding by the rules. But this is going to be a long road. And I think that the fact that we have the CFTC, the Fed, the SEC, the state regulators, and the Comptroller of Currency, and many others, it does bring some complexity to the space.
Yeah.
So Daren, just to put you on the spot for the moment, what are some of the specific regulatory challenges that you face in your role?
Sure. Yeah. I mean, the landscape is so hostile. Let's face it. As entrepreneurs, it is a downright hostile environment for innovation. So you have to make certain decisions evasively. You have to say, wow, we just can't even go down that road because look at all the landmines. That's untenable. Like, even if we lawyer up and finance up, that's an untenable road to take. Let's pivot and let's go this way. Our firm, for example, has just chosen to stick with layer 1 Bitcoin related products and services, which frankly are the simplest, most straightforward, and least regulated environment. And we do that for a number of reasons. We also feel it best serves our client base, but what's coming down the pipe is a little bit crazy. I find the mad dash by all the different the whole of government approach to respond to that executive order. I find it a little bit amusing. It's a mad scramble by these people who are really way behind in terms of their cognition and understanding of what this industry is about. And we've evolved as human beings since 1933 as well. We don't need the government to rescue us from every last little what-if scenario. So I'm questioning whether that process is going to be productive. And, just going a little further here, if you just, genuflect on one knee and just ask, what should I be doing? I mean, is that really a good position to take as an entrepreneur? I'm not sure it is. I don't know if you're going to ever get a favorable answer if you do that. So you do have to take a lot of risks where there's a lot of unknowns, and they have to be calculated risks. You got to talk to your crypto lawyers at a high rate of pay and see what they think is a good plan for you as well, and factor that in. Yeah.
Yeah.
Paul, did you want to add anything to the?
No, only for the fact that I can relate to paying lawyers. No, but it's an interesting space. I mean, going back, kind of something to what Tom said earlier. I mean, I spent a lot of my career working in designing anti-financial crime systems for banks and into the traditional. I think one of the big things that I found just educating people is, I think there was a panelist mentioned earlier when they were talking to, regulate or to legal representation and politicians on the Hill back in 2017, they were educating on how far they had come. There was a huge perception that, like, if you were in this space, that you were somehow, like, connected with criminal activity or drug trafficking or whatever. I think the piece that's really interesting for me is the opportunity here to actually create a far cleaner ecosystem, right? So I don't know how much you guys know about the current kind of, from an AML or money laundering situation, but it's up to most organizations to independently report when they observe illicit behavior. When you look at from a blockchain perspective, you can actually socialize, you can actually identify things like suspicious wallets potentially and share that as an ecosystem. And actually, as a result, it's kind of a rising tide that lifts all boats. When you explain that in terms of the rate, there's actually an opportunity here to actually do something far more efficient and actually far cleaner. It creates a lot of interest. I think that's where the real opportunity is. And everyone knows how much, dealing with compliance and regulation, how much overhead that creates for every organization. But there's real legitimate reasons in terms of adopting blockchain for the exchange of payments and actually doing it actually can incorporate a lot of efficiency. So, going back to the question, Marissa, I think it's education. I think pushing that point home that there's an opportunity to actually do things far better. So, Daren mentioned the point that we're dealing with SEC regulation back from the 30s. I think we're dealing with technology and compliance systems that were layered in and built around that kind of regulation. But there's now a chance to completely revolutionize and fundamentally shift that to kind of address the current challenges we're dealing with. So I think that has a lot of merit when you're talking with people in the regulatory authorities and and you're seeing movement as well. I think what's interesting at the regulators, they're bringing a lot of, let's say, private sector domain expertise as well into it. So there's an acknowledgement in terms of education that they have to kind of fill as well, so they can actually do this the right way.
When you mentioned sort of sharing that information, that reminds me that there are those blockchain analytics service providers who are doing that identification today that, most firms are paying for, but they also are, and I think Chainalysis might be one of them, also offering some of those services for free on their website to be able to hook up to see if these wallets, are from a high-risk jurisdiction or a sanctioned jurisdiction or have, something to do with the dark net, et cetera. So that is available more openly now. So again, let's switch into risk of loss and talk about security. So I forget who mentioned it. Somebody mentioned rug pulls before. We saw sort of the ICO scams from a few years back. It seems like there continue to be scams that kind of make the news. But I think, Paul, you might have even mentioned hacks in the industry that we've been hearing about recently, these bridge hacks. So Tom, as it relates to these bridge hacks, would you mind just describing like what that's really referring to, what the bridge hack is, and then what wrapping is, et cetera?
Sure. So I'll take a step back. When you look at some of these issues and losses, they're behavioral. People have misbehaved. They've created something and then immediately pulled their money out and left you losing money. And then there's the technological issues that either you create a scenario where that money can be hacked, well, not easily, but it is possible to hack it. And that's what we're seeing in DeFi, which is starting to I think there's some more awareness that as you go from one chain to the other chain, each chain is built for efficiency and with certain protocols and a specific programming language. When you go to another chain, that is where you're seeing a lot of these issues. So one solution is to wrap it. So you have the asset which you're going to wrap it up on one chain. You're then going to bridge it over to the other chain. And what you're creating is a vault on the first chain, and you're issuing something out of the second chain. So you're seeing that become a big issue for where hackers are seeing some success. The big chains have lost upwards of $1 billion over the last 12 months. If anything, we're seeing those losses increase. So we know this is an issue, and getting, if you have a token on one chain, getting that to another token on another chain, that's not a trivial process. And I think as you get more chains out there, you're going to see more and more needs for solutions around this.
Yeah, and just to add to a few points that Tom was saying there. So one of the other myths that I'd like to dispel, right? So in terms of the ecosystem, right? So yeah, we hear all the time about kind of bridges exposures and things. A lot of that is driven by code exploitations, right, from bridges. I think we do some work in terms of looking at auditing of code, but it's actually, people talk about open source. It's actually one of the implications of people leveraging code from GitHub and stuff like that to build people. Typically, a lot of bad actors are planting Trojan horses so they can actually exploit them, right? So that's a big part of the process. But I think the other myth, and Marissa had mentioned companies like Chainalysis. There's one company we work with called Elliptic. What's very interesting is actually the ability now to track and trace the activity. So, for example, even though we're seeing the breaches being a larger amount, the ability to actually identify and retrieve those assets, the capability has really, has really grown by a level of magnitude, right? So you have the ability now to track information through these tumblers and mixers, because if you think of it, the chain itself is a zero-sum game. So there's very advanced analytic capabilities to actually trace the information. And law enforcement have actually got really good at identifying and seizing those wallets, right? So I'm sure people were watching the news. Bitfinex, for example, right? That was exposed back in 2016. The assets were redeemed in January of this year, right? It took 6 years, but what happened in that particular case was that they knew where the assets were, but they were waiting for the bad actor to reveal themselves so the assets could be redeemed, right? So that capability is only going to increase, right? So, I think it's one of the key takeaways I would have for you today is the concept of security. Yes, we're dealing with a kind of an evolving ecosystem, and as we evolve in the ecosystem, we had started out with breaches in exchanges. We're now dealing with breaches in bridges. But the ability for those assets to actually be tracked and redeemed and retrieved is also growing. So actually, we're actually building in a way, a better safety net than we ever had with cash, right? So the comparison with things like credit card fraud. The reason why your credit card provider in a lot of cases charge you a high percentage rate is they know that in large cases the losses are written off. The retrieval rate is about 1 to 2%. We can change that game in terms of blockchain forensics. And so there's a real opportunity.
Great. Daren, anything additional to add to potential security risks that exist or things we should be thinking about today?
Just my last thought on that, Marissa, would just be regarding risk of loss. I think the crypto providers out there in our industry who can provide, plan B and plan C and backups and think through the process for their clients. Obviously, consumers are not able to think through all the what-if scenarios. We, as providers, are in a much better position to design the system to avoid risk of loss and to avoid, again, plans B and C for the consumer to retrieve funds in the case that they lose access in some other way. I think those providers will thrive because consumers will naturally gravitate towards the ones who say, oh yeah, they thought of this for me, so I don't have to worry that I both lost my password and I lost my backup key. So we strive to do that, and I see other industry players doing that as well, and that's what we want to be doing.
I think that since I know we're running a little ahead of time, I actually think that would be neat to talk about. Not that we sort of prep this conversation, but be thinking about, one of the report outs was related to consumer protection. You're talking about things evolving in that space. So I think, folks are always worried about security breaches or insolvency or bankruptcy. what solutions do you see coming online? And maybe pose this for the whole panel. What additional solutions do you see coming to protect investors in this space?
Can I go? I'm actually going to give Paul's company a plug. So what a possibility out there is when you own, let's just say, Bitcoins in an on-chain wallet, you can, of course, anybody can see them online with a block explorer, right? Your name's not attached to them. It's totally free of identity, but you can see there's my one Bitcoin at this wallet address. However, can you prove that that is your wallet address? That's a little more nuanced and difficult to prove. And some of the crypto OGs will say, oh yeah, I'll just sign a transaction and send it to you, but most normal people don't know how to do that, nor does much modern software offer that. So proving ownership and provenance of a wallet, I think, is an interesting way of maybe having a little more legal recourse if in the case that something does occur to your coins. You can say, well, I had my coins. They belong to me because I can prove through this document that I own that wallet right there, and so therefore I'd like access to those coins, and you can be saying this to the provider that it might be in custody with, for example. So I think that's a really interesting development, and I'd love to see some of that in our business too.
Thanks, Daren.
Yeah.
No, I mean, I suppose just to go back on some of the things we said, I think about the opportunity in terms of these infrastructural pieces that need to be built. The big thing that we were looking at was the kind of digital chain of custody, right? So, for example, and we're seeing some very real issues. I mean, we're seeing things like we're coming up in 10 years now where people were either mining or buying Bitcoin. Estate planning, right? So how do people actually have a legal record of what actually assets they have entail? If you're like me and you have 10 different wallets across 10 different assets, oftentimes that's difficult. If you have your assets custodied at a third party, we had the disclosure with that well-known exchange back in May, right? That created a lot of anxiety. So what would you do if you happen to be an account holder at Celsius? How would you qualify as a creditor? So it's actually, that's the issue that we're thinking about in creating kind of a digital chain of custody so that you have an independent record around that. I think then mixing that with, I think, the ability now to track and trace and retrieve, there's real opportunity to create a much tighter risk management system for the whole kind of ecosystem.
And I'll jump in sort of from a different angle on more of the yield farming and DeFi side of things. When we first started looking a few years ago at lending through companies like Aave or Compound, where you're doing collateralized lending, we were lending stable coins against crypto assets. We had this sort of quagmire. We're trying to back out what's the appropriate risk for that, because if you're getting 8%, well, the credit spread seems awfully wide for something that is a short-dated loan. But what really pushed that spread out was the fact that you do have this risk of hacking or risk of loss. And how do you manage that risk? So we've actually had some discussions with insurance companies and Lloyd's of London syndicates about offering that insurance as a way of saying, we can get you great yields. We're going to give some of that away in insurance, but ultimately you'll have that hacking risk covered. So what we hopefully can find the right ways of capitalizing on yield farming or on DeFi lending, but ideally this will be done in a way that you have peace of mind that should there be a hack, you're covered. I think over time you'll see insurance step in more and more. 3 or 4 years ago, there was this big unknown, much like cybersecurity sort of 10 years ago. Now you're seeing a more liquid and more innovative insurance market as well.
Yeah,
That's great.
definitely.
Yeah, I feel like when it comes to types of insurance that thinking through like state regulators and the different insurance that's required, and thinking about like crime insurance and all of those things that you didn't traditionally think you needed, just based on employees doing things, or, you've got like all sorts of ways that somebody might be able to get at these assets. And kind of going back to our regulatory conversation, that sort of being an evolving area where nobody sort of has the same view on it. So what you find is it's a patchwork for a company to pull together exactly what you need in place to provide that security to the company. So thinking through some of the topics that we talked about, before we actually open this up for just a few minutes, I think we're going to have for questions. But before we do that, there's still a lot of value that can be created in this space, thinking about custody in general. So what do you see? So asking this question to the three of you, what do you see as one innovation that can be made in the custody space overall?
That's a good question. I think that we were on a call a couple days ago with someone in the NFT space, and one of their challenges is a lot of people are now getting NFTs in their wallets. They're getting assets in their wallets, some of which are collectible type assets, may or may not be worth a lot of money, but how do they manage that? How do they keep up with it? How do they make sure they've got some type of solution? I think over time, you've got to get a more user-friendly user experience that allows for the common person who doesn't have a deep background in programming, the ability to manage those wallets more efficiently, to be able to engage with those wallets more efficiently, and to also manage what's in their wallet more efficiently. I think that we've got a long way to go there. I'm not sure if I answered your question the way that these guys may answer it, but I think that we've been having a lot of discussions on what would make it easier for the non-technical people to engage more in yield farming and DeFi lending and DeFi applications in a way that's a little bit easier for the common man to do it.
Yeah. I mean, if I had to, maybe not to be repetitive, but I actually think one of the issues that hasn't been kind of properly kind of discussed is the concept of, we talk about custody, but legal ownership, right? We talk about the definition of ownership. So, if you take the legal definition, possession is what, 9/10 of the law. So you think about that logically in terms of what that means in terms of the layer 1 versus layer 2, right? So I think people don't understand, I think that risk is, and we're going to potentially see, given the kind of current macroeconomic situation, perhaps more insolvencies, more kind of issues in the space. What does that mean for you as an investor? So I think what needs to happen, and I actually think it's the crux of a lot of the problems with the regulatory challenges right now, is defining this very, very specific component around legal custody and ownership. And it actually, I think, a lot of the anxiety from a regulatory perspective would be resolved if there was some authority that actually was tracking this independent means in some way, right? So, and this is why we're pursuing the problem, but I think that's what's required, right? So, you also had, so for example, people talk about, the biggest issue is consumer protection. You talk about insurance, even with insurance, coverage is very limited when it's available at all. Tom looked at different ways. I think there's real opportunity to expand insurance in this space. But I think the other protections in terms of security protections, everything will continue to evolve, which will only help these other areas. So.
Yeah. I think the killer app is collaborative custody. And by that, I mean multi-signature custodial relationship for your coins. I think that just solves so many problems all in one fell swoop. You don't trigger Custody Act stuff. You don't trigger, you have all sorts of ways to back up and retrieve money. It is a fantastic way to both manage risk, regulatory, and just best serve the customer's needs as an intelligent human being. We're gonna, we as the FinServe are gonna hold your hand and hold these coins with you in collaboration. I think that's a great model, and I want to see more of that development going on.
Great. All right, so we actually have probably time for, I'd say, maybe 3 or so questions. So I'd love to open it up. Are there any questions that folks have related to custody, the regulatory environment we've been discussing, risks, securities?
Hi everyone, my name is Chris. I run a blockchain company in Nairobi, Kenya. Happy to be here. My question to the panel is, there have been some attempts in some country to ban self-custodial wallets, for example. What does the panel think about some of this? Because some of us in the Bitcoin space, we believe that not your key, not your money. So when there's attempts to, to this kind of banning self-custodial wallets, it's really a big harm to the ecosystem. So what do you think would be an alternative for this kind of, behavior in some countries?
Yes, I mean, if I want to jump in there, but so if I get your question, it's about private key. So possession of your private key essentially represents legal ownership, right? So it's both the strength and the weakness, right, of the blockchain, right? So this is I think the issue, and we see it as well. We could come across cases where someone has come to us and they've lost their key, and the biggest problem actually from a forensic standpoint is actually how do you verify that? How do you authenticate in the first place that their asset is even theirs, right? Everyone's heard about the famous case of the guy in the landfill in Wales with 200 million in Bitcoin. And that is actually one of the biggest problems when a lot of forensic companies are dealing with it. If someone came to them with a wallet and say, I lost the key, how do I actually verify that it's mine? So it's the strength and the weakness, right? So asymmetric cryptography by definition is very, in terms of its ability to be hacked, is obviously very strong. But then if you lose your passphrase or your private key, that's ultimately the implication of it, right? But there's, as Daren said, there's other types of providers now available that can do that. So if your concern of losing your private key is your concern, there's ways to risk mitigate that, right? With multi-sig wallets and other types of situations, right? If there's ways that you want to, if you're not comfortable in that environment, then that's why you would move it to a custodian, for example. So there's ways to mitigate the risk, I think, is the question. But it is the weakness, fundamentally, of self-custody of assets, right?
And do we have another question?
Firstly, I want to thank the panel for the time. Really appreciate the insights you've been sharing. It's been really keen listening to you. I'm quite curious about your stance on the upcoming MiCA framework, markets and crypto assets, and what implications it might have for custody, ownership, so on and so on.
And referring to European Union?
Yes, absolutely.
I don't have anything to say on that.
The question was the upcoming.
So it was the markets and crypto assets, the European Union. Is it 2024 that it's going live? So, I mean, I think it's, thinking through, yeah.
I'll touch on this. So in my previous company, we had actually pitched the FinTech Innovation Group at the Central Bank of Ireland, which is the regulator in Ireland, on doing a DeFi fund. And one of the big challenges was that Europe, which is a reasonably big collection of countries that don't always agree, had not established any crypto rules. There was no framework in place. I think that I don't know exactly where what it will end up being or when it will be finalized, but my sense is that they will roll this out. For one reason, they don't want to be left behind. France, Ireland both have very growing fintech scenes. There's a lot of pressure to come up with something that would work European-wide, and at the same time, you're getting the UK really being quite innovative there. But Ireland's always been if you look at a lot of the big corporates in America, they keep the majority of their dollars from their international earnings in Ireland for tax reasons. There's a lot of the European economy has found ways to attract capital through being innovative, and some of their processes, some of their taxes, and some of their regulatory implementations, they realize that you want to bring that next new economy. And there's a lot of awareness in both the UK and Europe around blockchain jobs, and the ability to really harness the value there. They're going to protect their consumer. We think that's something that you're going to have to deal with. But generally speaking, our conversations has been, if you want to market this to accredited investors, we want to help you. We need all of our legislation in place first, but that's something they will figure out. But we think that that's something the U.S. is going to have to figure out how to work with the rest of the world on, and the same with the other large countries in the world. Will all kind of work together on something that will ensure that you've got some common sense approach.
And I think even, kind of getting down into the weeds, I think it's even taking it like item by item and figuring out whether it's like scope of customer and who can, who has access to certain assets on the platform, or just even like what disclosures need to say now. I think it's just prepping for all of those changes to come through either the platform itself or disclosures to consumers, customers, et cetera. So I think we maybe have time for one more question if there are any. And, oh, right there. Then we'll close it out.
Hi, appreciate the panel. My name is Sheldon.
there.
I'm actually running a smart contract analytics company. And given the fact that we're talking about custody and ownership, I'd love to get the panel's take on like privacy, especially in relation to the recent things that happened with Tornado Cash and how privacy relates to custody and how you guys think about that. Thank you.
So thinking about kind of thinking about the future of privacy when things happen like Tornado Cash and all of a sudden you've got like a protocol that's actually being called into question potentially.
Yeah.
Does someone want to?
I mean, I'll give it a go. I mean, certainly what happened, I think, broke a precedent, right? So you have actually a piece of code being sanctioned. I can talk a little bit about the reason behind it. I mean, so you probably saw on the news, I mean, the reason it occurred was that it was, they reckoned about $1.5 billion worth of dollars was siphoned through it to North Korea, right? So that was the reason. I think they didn't necessarily know any other way, I think, to actually shut down that funnel. That was the issue, right? But it does set a precedent, right? And I think one of the panelists talked about it earlier is where ultimately now there's accountability to talk about. You know, you talk about DAOs, you talk about all these other things. Are we now changing the paradigm potentially in how actually who's responsible in terms of these activities, right? So I think it'll be, just watch the space. I don't think it'll be the first thing that'll occur. I know why it occurred because I don't think they knew any other way for it to shut it down. But I think just continue to watch the space because I think it'll happen again.
But I think even with the FAQs that OFAC issued very soon after, I think that was a sign that they're paying attention to this. They realized that there was this outcry over, what does this mean for the rest of privacy coins, et cetera, in the industry. And I think what's really challenging too is when you think about those blockchain analytics service providers that we were talking about, like the Chainalysis, Elliptic, CRM Labs of the world, CipherTrace, et cetera, those, they have different classifications. And so if you have a privacy coin that for some reason in that classification shows up as a mixer or tumbler, there's certain levels of risk that come along with that a firm sees and goes, oh, I don't know, you're dealing with that. So that can have effect on, those who are from those organizations. So I do think that this is going to be an area that's going to continue to evolve to figure out what are they really trying to block or prevent.
Yeah, and I'll just add a punctuation mark to that. I'm so glad you brought up the word privacy. We could have a whole conference on that alone. I believe that privacy is the cornerstone to a free society, so it should be respected. And I think it was just very much violated with that sanction of that contract, and it remains to be seen. The fallout from that. So let's maybe do a TBD and maybe another conference or breakout session on privacy.
And I'll give final.
Do we have one more question?
Oh, I'm sorry. Yes. Okay. That's what you were pointing out. Thank you.
Thank you. Hello, I'm Dimitri. I'm manager of the Atticus project. And my question would be, do you see any replication between the real world trust and a blockchain trust? For example, if I want my kids to inherit my assets in the real world, can it be replicated in the blockchain world? What would be your thoughts on that?
I'll take that. I mean, I have had conversations with our corporate attorneys about this. I mean, luckily, any assets can be run through basically the same legal framework that we have for probate currently. So that's the good news, is you don't need to invent a new legal system. You can run it through the same exact process. But then I think it just comes down to logistics, like, the heirs aren't going to know where your private keys are unless you make a plan, unless you have a very specific plan in place. They're not going to know much of anything about your assets unless you disclose them and put them in an appropriate place or store them with your estate attorney, et cetera. So yeah, maybe there could be a few. Maybe you can start a company to deal with heir and estate issues related to digital assets.
Great. Well, on that note, we'll close out for the day. So thank you so much for attending this panel, and thank you to our panelists.
Thank you.